Tomas, that music can mean only one thing. Let me explain with Chris Vecchio. How are you, my friend? Welcome to the show.
Oh, gentlemen, happy blessings to you. It is almost a high holiday here for us in the macro world. Tomorrow is June inflation report.
I thought my birthday. Tomorrow's my birthday. I thought you were going to talk about my birthday.
Tony Batista's birthday.
It is a high holiday.
Well, we just had that pre-chatter. Apparently, I'm no longer allowed to have my birthday in the month of July. So tomorrow will be a high holiday for two reasons. We're going to be talking about inflation and, of course, Mr. Batista here. Happy birthday in advance. I won't forget yours, unlike others who may have forgotten Anton's.
Thank you. Appreciate it.
In case you know, Chris, every day is his birthday here.
Yes. Christmas
Every
is
day
my
is
birthday.
Christmas, yeah.
If it's not Christmas, it's a downtick to my birthday.
Yeah.
Yes.
So every day we have to celebrate Tony Batista and his, whatever. All right, man.
Personally, I think you've earned it.
Oh, you're killing me. All right, what's going on?
Well, we should talk about this inflation report that's coming out tomorrow. There's certainly been some interesting data that's been released in recent days that have been moving markets around. Last week's moves around, say, the JOLTS report and the non-farm payrolls report could have been a symptom of what are lower liquidity conditions coming out of the holiday. It was a pretty quiet week on the liquidity front. When you look at the number of contracts traded across, CL or ES in the futures market. But things are coming back to normal this week. And tomorrow's inflation report should be instrumental insofar as it could mark the low point for inflation that we've seen since the peak last June. Economists are forecasting a 3.1% reading year over year on the headline. And to me, that's ultimately one of the reasons why we're seeing a market that's beginning to price in fewer Fed rate hikes. I'm wondering if this could be a false dawn, however, because if we take a look at the Fed's own projections, they don't see markets getting back to a 2% inflation rate sometime until 2025. So there's a bit of a disconnect here, guys. I wanted to lead on to you for this. Perhaps you could explain this to me. There have been periods in the past when the Fed has undershot and overshot its overall rate hike efforts. We saw this actually just a few years ago when inflation started going up. They dismissed it as transitory. They waited too long. Then they've done a lot more aggressive rate hikes since then. The market's beginning to show signs that they think the Fed is overdoing it. When you go to the swaps market right now, the curve is no longer inverted, which is noticeable because it's been inverted basically for the past 2 years. Inflation a year from now is expected to be lower than inflation 2 years from now, from 3, from 4. And when you go out and you look beyond that, you go to the five-year inflation swap forward. So if 5 years from now, what will the average inflation rate be for the next 5 years thereafter? We're only looking at about 2.6%. The market's telling us the inflation story is finished. The Fed clearly has other plans. I've done a little bit of research into what happens when we see this kind of discrepancy. It usually doesn't end good. But in your guys' experience here, when the Fed overshoots on monetary policy tightening, what tends to suffer the most? Share your wisdom.
Don't hold anything back.
Okay, you have to understand, Chris, this is a very difficult topic for me because
I understand.
With any other person, I would have already hung up this conversation. And because there's not one second of this which I'm not suggesting anything you're saying is absurd or crazy or.
No, that's exactly what he's suggesting.
What I'm about to say is that there's not.
But the Nasdaq just downticked, so he's a little bit in a better mood.
There's not one piece of this conversation that will change one thing that I do as a trader. And I think that's the important takeaway, because I think that people get really confused. They get confused about, financial talk and interpretation of
that's well said. That's about the best way you've said it.
Of numbers, of reports, of meaning. Like we answered a couple questions this morning, like what does a recession mean? What does a rebound? I can't stress anymore. I'm a hardcore efficient market person. Does the Fed ever get to the point where it gets overdone? They go too far in one direction. Sure. You know why? Because of all the biases that we just talked about on the last segment, the Fed is subject to all the same biases because all they are just, economists from academia. There's essentially nobody there that's ever traded before. So they're subject to virtually every bias that's out there. And they all see the same thing, make the same decision at the same point, and they're probably subject to this herd mentality where they're going to get to, especially in large moves, they're going to get to various extremes. And I think you saw it the most obvious example of the last couple of decades is when they lowered rates way past the point of what I would call reasonable or smart, because knowing that you have an unwind that's about to come, what happened is they went to an extreme on the lowering rates and they went to an extreme on the raising rates. And I think what the Fed's going to learn from this, just like they learned from adding liquidity in 2008 and being able to add tons of liquidity in 2020 for the pandemic, I think the takeaway for the Fed is going to be one where they've learned, hey, you know what? We need to be more proactive, less reactive, and we need to avoid pushing ourselves into a corner or backing ourselves into a corner where we go to an extreme. So are we at an extreme now? I mean, I felt, and I'm always bearish on bonds, I felt yesterday that we got to an extreme in price when we ticked down under 123 in the bonds. And I think we're pretty close to an extreme in short-term rates. That's me as a trader. I think we're close to an extreme in the yield curve at 100 basis points under 2s under 10s. But that doesn't mean that I care one bit about what the numbers are tomorrow or how the Fed interprets those numbers, if that makes any sense.
That's exactly where I wanted you to go with this. I like that I got to wind you up for you to say that we shouldn't really care what the Fed thinks tomorrow, because it sounds better coming from you than from me. I agree with you, quite frankly. I think tomorrow's report could be a bit of a false dawn. So whatever the numbers say, the market's going to tell us what the correct response is to it. I find the price action in bonds actually very interesting here, and that's where I wanted to go with this next. From a technical perspective, yesterday was pretty important. If you look at the 10s, you put a new high in for yields, and we barely just missed putting in a key reversal of what has been a recent high. That's just a bearish outside engulfing bar. We have a new high relative to the prior trading session. We closed below the prior trading session's low. It's a sign of a top. We didn't get that, but we came within 0.001% of achieving that. That, to me, is a really interesting technical development, because it means that the market thinks that we're getting close to the end of the Fed hike cycle. But perhaps the most interesting aspect of what happened in the 10s is now if you look at ZN, ZT, ZB, heck, throw in ZF and UV, ZN now has the highest IDR. There has been a shift in these markets recently where the mantra and the focus point has moved away from what the Fed is doing into how the Fed's actions are impacting the economy. And I say that because throughout the hike cycle, if you take a look at what was happening in the IVRs, it was always ZT, the 2-year notes, that was ground zero for moves in interest rates. And that makes sense. The short end of the curve reflects what the Fed's doing a little bit more closely than the long end of the curve. But in recent days, over the past 2 weeks, we've started to see that volatility focus point move out along the curve. And now it's sitting in the 10s. And so when you see the NFP report, it's the 10-year that's moving the most. When we had last week's JOLTS data, it was the 10s moving the most. Tomorrow, it's very possible that the 10s are moving the most as well. That, to me, is a sign that the market is thinking past the Fed, that we may get a hike this month, but don't get wrapped up in that. It doesn't really matter to us. What matters to us as traders is the price action in front of us. We need to ignore the narrative, because the narrative is shifting below our very feet. It's incredible how this happens sometimes, guys. It's just a flip of the calendar. We go from 2022 into 2023, or even a better example, we go from 2021 into 2022, and all of a sudden what was a great stock market begins to fall apart in just the first few days of the new year. For what reason? It was just a new calendar. It feels like that here in the second half of the year, where now that we're in July, things have started to change. The Russell doing really well without banks. We're seeing interest rates move a little bit more, we'll call it normal, starting to see some steepening. Steepening is the next part of this conversation, Tom and Tony. You guys and I have been talking about this for months and months and months. Is it time to look at steepener trades now?
It's our biggest position. So, I mean, when you say is it time, I mean, we
would argue it's been time, and we would argue we were wrong.
We've been in the trade.
Right.
We've been in the trade now for, I mean, I'm one roll into it, so we've been in the trade for, close to 30 to 40 days at this point. We're down a little today, but as of yesterday, we're we're pretty close to being unchanged on the trade from when we did it. We did it around, it's around 90 basis points. That's about our average. We have some at 80 and some at 100, so we're averaging right around 90. And yesterday was right around 90 basis points under. I think the Steepener trade is, I mean, in my opinion, it's one of the 2 or 3 best trades on the board. But who knows? I mean, the problem with the Steepener trade is that it shouldn't have taken this long to reverse, and since it's taken this long, it's a little more scary.
If we were
to
right,
me.
we should have been right a long time ago.
Yeah, like we should have been right a year ago, and since it's taken so long, it's a little more scary to me. Like it's going to hang around here, like nobody. I would have never thought we would stay inverted for a full year, and we did. So I do think the Steepener trade's the trade. Like if I was just doing it here for the first time, I'd be thinking about it more as a trade. I'm thinking about it more as like kind of a core position right now, because I don't see how it's going to sustain 100 basis points under for that long. Mm-hmm. But getting back to a point you made about, I think we should bring it up, like the IVR in the ZN or the ZT. Like one of the things that people get a little bit. Sometimes they get a little nervous about. They'll look at SR. They'll look at SR, which is the old euro dollar, and they'll say things like, "Wow, the IB rank is really high in there." But there's a reason for that. The short-term paper, in the current environment right now, the shorter you go, the more volatility risk you're going to have. The longer you go, the smoother the curve is going to be. Nobody cares. And so it's essentially a little like volatility. All your front month risk, all your backwardation risk right now is up close. And long term, nobody looks at the market like there's a lot of risk. So you're going to find much lower volatility risk in the 30-year and the 10-year than you would in like the 2s and 5s and in the overnight paper right now. Just because we're still at that, that flux period. But I do think, getting back to your bond discussion, I do think we got to the point very recently where, basically yesterday morning, where bonds got to a level where the sellers got completely exhausted. So I think what's really interesting about this is they tried to rally a little bit more today. They're right back to that 124 level. I'm kind of hoping that the trade that sets up tomorrow is a sell-off in the bonds, and we have a chance to do a little scoopy around 123. I think the bonds are going to be a real interesting put sale, yield curve trade, or whatever you want to do in that 122.5, 123 level. We're only a point away. So that's what I'm hoping for tomorrow.
And if people are uncomfortable trading the bonds, one such proxy for what's been going on in the bond market has basically been gold prices over the past few months. The fact that we've seen gold stabilize here around 1900 while yields have started to turn lower and the dollar has started to weaken sets up an interesting scenario where if you break back through 1950, it basically becomes a clear run up to $2,000 an ounce. And so you have a bit of confirmation signal that you can look for, right? If the bond market is going to show signs that we have indeed bottomed, gold theoretically should be a participant in that, at least from my eyes. Now, that doesn't work with my positioning. I'm short from 1937. I added into my short last week because I rolled out of my short yen trade on Thursday before the fireworks went off, which I'm very thankful for. And I added back into gold because the whole idea was short yen, short gold. It's basically the same trade. Yields are going up. It's going to hurt these yieldless or low yielding type of instruments. But now I'm reassessing my position because, of course, I got out of the way for the yen move. Gold has not really popped off yet, but it seems like it could be a matter of time. So I may be joining you, shifting my allocation in the next few hours away from gold and into bonds. I like the idea tomorrow, though, that we can think about the historical tendency. If you go back and look at every single Fed hike cycle, when do bonds tend to bottom? It's usually the meeting prior to the final rate hike, which this could be considered that if the market pricing is to be held true. You say it's super efficient. We're getting a hike in July. We're probably getting one in September. And then afterwards, we may not see anything else. And so if tomorrow's CPI report does give us a sign that maybe we see a 2 handle on inflation, I don't think the Fed's going to stop here, but the market will certainly begin to treat it like this is a done deal. One of the big components for inflation over the past year has been used car prices. In fact, at the peak in last June, used car prices accounted for a third of total inflation in the United States. So when we were at 9.1%, used cars were adding 3 of that 9.1%. Yesterday, we just saw the second largest drop in history in the used car price index. The only other time it was larger was April 2020, when the economy was falling apart at the start of COVID. And so there is a real deflationary impulse making its way through the economy right now. We can't dismiss that. But if the Fed starts to see those 2% readings, bonds have no business being this cheap. And the Steepener trade, in my opinion, becomes exceptionally viable over the next few weeks and months. It's finally a live fire drill as opposed to hoping and waiting. We may see the turn. It's been a trade that I've been watching. It's been on my watch list. Haven't traded it yet, but I'm very close to joining you gentlemen in there. Steepener, here we come.
The funniest thing about the Steepener trade, and we were talking about this yesterday, is that for years it was a short delta trade. I mean, it was a short bond trade. Now you're talking about it as like it's a long bond trade, which is really weird because you're playing it as a long bond trade, and I'm playing it as a long bond trade. But I originally put this trade on for years and years and years as a totally delta short trade. You know, because you're basically short the long term and long the short term, and in pure deltas, you know, it's a short position, but we're playing it as a long position. It's so weird how those things move around. Getting back to gold,
you were playing it as a bear steepener, and now you're playing it as a bull steepener, is what you're saying.
You don't play it as, you're playing it as a steepener, a basis trade, which is what the steepener is, a pairs trade. It's a basis trade. A basis trade is you're just playing the spread. But yes, I was playing it thinking that bonds were going to go lower, and in fact, effectively, as bonds went lower, the trade flattened. So it went completely the opposite way. It's always going in history, which is crazy, but it is what it is. But I want to get back to gold and maybe even touch on silver for a second. The problem there is that you have no volatility right now. So you have a market where if you're going to trade gold, and silver is even worse, if you're going to trade gold here, you've got to go in pure directional.
Yeah.
And if you go into gold as a pure directional play here, you know, there's no juice, and we're premium sellers. So if you're bullish, you sell puts. If you're bearish, you sell calls. I just don't like the play. There's nothing to do. Like it's just too cheap. You know, the options in there in the futures market
is just,
yeah, volatility is like nothing. And I mean, silver vol right now, let's take a look. It's down to like 26. It's usually like in the 40s.
I rank of 8.
Yeah, and gold vol is I mean, here's the crazy thing. Gold vol right now is 12. Okay? Gold, 12. How do you trade gold with a vol of 12? Do you know what the...
How do you trade almost anything with a vol of 12?
The vol in 30-year bonds, this is how nuts it is. The vol in 30-year bonds is 14 or 15. The vol in gold is 12.
Gold is less volatile than bonds.
Yeah, you can't trade gold at 12 vol. There's just like that's the problem with it. So when you talked about gold, I was like looking at it, I'm like, you know, I wish there was something to do in here because I like trading GLD and I like trading GC, but at these current prices, you know, you cannot trade gold with a vol of 12 unless you're going to play it. You know, unless you're playing short-term timing and you're like, you know, you're buying a straddler. I don't even know what you're going to do. You know, how would you play?
Gold's difficult to play right now. You mentioned the volatility situation. One of the unique things about gold is that it actually can have a positive correlation with volatility over time. So when gold comes down, volatility usually compresses, and when gold is going up, it's expanding, right? Why does vol go up? People panic sell, we'll call it that, shorthand. People don't panic buy stocks, they panic sell stocks. But on the other hand, people panic buy gold. It's a safe haven asset. And so if you're thinking about getting short this market right now, are you really going to want to go in there and say sell calls? Because if the market starts to move up, you're going to get hit on both ends, right? Volatility expansion is going to move against you, and this price closes in on your strike, you could potentially be on the other side of a losing trade very, very quickly. You have to be directionally, you know, just got to do it short. So I've been shorting through the spot directly because I don't find the options market to be that appealing. But we're getting pretty close to the point where I'm ready to say, you know, I'm going to pull the ripcord here. It was nice to average in after using some of the yen proceeds. And if I can just close these two net on a win, I'm not going to get too wrapped up about it, particularly given the environment that we're facing right now. But gold, to me, it's very difficult to go through options. I've had this conversation with Anton and Dramal on Futures Power Hour in recent weeks. This is just not the environment to go into gold or silver. from the options perspective.
No, there's no juice. And, options are a juice play. That's the beauty of options, leverage and juice. And the leverage is always going to be there, but the juice is not. So anyway, yeah, that's the gold play. All right. Gold, we talk bonds. What else you got? Closing words.
I just hope that Tony has a great birthday tomorrow.
Good, well played. And I hope you have a good one next week.
Most of the time, he rates his birthdays based on
someone else's performance.
Okay, I'll leave it there. And given the fact that he's probably bound to say something.
I'm a seasoned veteran at this now. I've gotten a lot older.
And based on the fact that he's a 90, there's about a 95 plus delta that he's going to say or do something stupid during the day.
I'm going to ruin it.
He's going to ruin it. Yeah.
I'm going to ruin it. I'm going to ruin a short
he's
thing.
Probably going to be sleeping in the spare bedroom, and that's going to be his birthday. But he will get to blow out the candles at least. And he's kept his birthday wish. He hasn't sold it to me yet. We're going to be bidding for it tomorrow.
I appreciate your kind words, Chris.
Yeah.
Ready to take a quick 90-second break?
Thanks, Chris.
We'll take a quick 90-second break and come back with a market measure next.